Before we dive into the accounting equation, let's start by introducing the idea of assets. An asset is simply something valuable that a business owns that contributes to its revenue. According to the conceptual framework, an asset has three key features. First, it's a present economic resource. In other words, it's something that can produce economic benefits either now or later in the future. Second, the business must control that resource. This means that the business has the power to use the asset and decide how those economic benefits will flow. And third, this control must arise as a result of a past event. So perhaps the business purchased the asset or received it through some other sort of transaction. So when we talk about assets in accounting, we're not just talking about things, we're talking about resources such as cash, machinery, or inventory that meet these three important conditions. This definition is incredibly important and forms the foundation of financial accounting and reporting. You need to be aware of each of these three elements that make up the definition of an asset before you walk into the exam, as each of the three components is incredibly important. Now that we know what an asset is, let's explore the three main types of assets. First, we have current assets. Current assets include cash, inventory, and items that are expected to be converted into cash within 1 year. These are the short-term resources of the business which are only expected to generate economic benefits within the next 12 months. Next, we have non-current assets. These are the long-term assets, the things the business uses over a longer time period, usually more than a year. This might be the company van, the office building, or machinery used in the production of the business's goods. And these assets are expected to generate economic benefits over a period of time longer than 12 months into the future. Non-current assets are typically physical in nature, so you can reach out and touch them, whereas intangible assets are non-physical, and they include things like intellectual property assets, patents, copyrights, software development costs, brands that hold significant value over time. Now that we understand the broad categories of assets, let's go one step further and explore some of the most common examples. Again, we'll begin by looking at current assets. As discussed on the previous slide, these are assets the business expects to use up, sell, or convert into cash within the next 12 months. A classic example is cash itself, the most liquid asset there is. Then we have inventory. These are the goods the business holds with the intention to sell. We also have trade receivables, which represent money owed to the business by its customers who've been sold goods or services on credit. Next, we have non-current assets, the long-term assets that the business uses to operate over the long term. These include land and buildings and motor vehicles such as delivery vans. We also have plant and machinery, which refers to equipment used in the production or manufacturing process. And also we have fixtures and fittings. These are the items like shelving, lighting, or furniture permanently attached to the business's building. Finally, we have our intangible assets. These are resources that bring value to the business, but that you can't physically touch. Think of things like software the business has purchased or developed itself internally. We also have capitalized development costs. These are the costs that the business has spent on creating a new product, service, or systems that are expected to deliver future economic benefits. So these examples should hopefully help illustrate the different types of assets used by businesses. Let's bring all this theory to life with an example which contrasts a business which is focused on current assets versus a business that's focused on non-current assets. So starting off, let's imagine a newsagent. Newsagents receive their newspapers in the morning and sell them during the day. Their focus is on current assets, turning over their inventory quickly to make a profit. Now let's compare that with a car manufacturer. They invest in long-term assets like plants, equipment, long-term software systems, just general non-current assets to help them produce and earn revenue over many years. Each business manages its assets very differently based on their strategy and industry. There's no right or wrong way to run a business. However, you need to be aware as an accountant that some businesses will have an asset base that is predominantly made up of current assets, while others will have an asset base which is predominantly made up of non-current assets. So, as discussed in the previous section, non-current assets are assets a business intends to keep using for more than one accounting period. They're not bought or sold on like an inventory, they're held to support the long-term operations of the business. So, examples of non-current assets include things like buildings, machinery, patents, and long-term investments. The key feature is that these assets help the business generate income over time, either directly or indirectly. They are typically held by a business for longer than 12 months before they're converted into cash. For an asset to be classed as non-current, it needs to meet two conditions. First, the business must use it within its operations. Secondly, they must use it for a period longer than 12 months. Non-current assets can be tangible, like machines and buildings, which are assets that you can physically reach out and touch, or they can be intangible, like patents or software licenses, which are assets that can't be physically touched. So remember, it's not about whether the asset is expensive or whether it's large in size. It's all about how long it's used by the business and why it's used by the business. That's how you classify something as non-current, if it's held and used over the long term. So let's compare tangible and intangible non-current assets in a bit more depth. Tangible assets are physical. We can see them, we can touch them, and they include things like machinery and land. Intangible assets, on the other hand, are non-physical, and they include things like brands or software licenses. In financial statements, tangible non-current assets are classified under the heading property, plant and equipment, while intangibles are usually shown separately and are often amortized as opposed to depreciated. Non-current assets can also include certain financial investments. For example, if Company A purchases shares in Company B and plans to hold them for a time period longer than a year, those shares will be classified as non-current assets as they're being held by the business for the long term. They'll appear on Company A's statement of financial position, not as cash or inventory, but as a non-current asset. When a business buys a long-term asset, something like a vehicle, a piece of machinery, or office equipment, that asset doesn't just benefit the business for 1 year. Instead, the asset is often used over several years, helping it generate income across multiple accounting periods. So rather than charging the full cost of the asset to the income statement in the year it's purchased, we spread the cost as an expense over the asset's useful life. This spreading of the cost is called depreciation. Depreciation recognises the wear and tear or gradual loss of value that happens as the asset is used. The aim here is to match the cost of the asset to the income it helps generate, giving a fair reflection of the true financial picture each year. There is an entire section on depreciation that's going to come up later in the module where we'll dive into the concept in much greater depth, but this is just an introduction. Now that we understand what depreciation is, let's look at how we calculate it. There are two elements that we need to consider. One, the useful life of the asset, and two, its residual value, sometimes called scrap or disposal value. The useful life is the time period over which the business expects to use the asset. Not necessarily how long the asset could survive, but how long the business intends to use it for. For example, a delivery van might physically last for 10 years, but if the business plans to replace it after 5 years, then the useful life for accounting purposes would be 5 years, not 10 years. Some assets like freehold land aren't depreciated at all because they typically have no limited useful life and can live on forever. So we would define land as having an indefinite useful life. So we don't depreciate land. The residual value is the estimated amount the business expects to receive if it sells or scraps the asset at the end of its useful life. The residual value number is based on the accountant's judgment. It's influenced by their experience and the prevailing market conditions at the time. It's important to understand that choosing longer useful lives or higher scrap values will reduce the amount of depreciation charged in each reporting period, which in turn will increase a business's profits. So as honest accountants, our estimates need to be realistic because we want to present a true and fair view of the asset's value and business performance. We don't want to be understating depreciation and artificially increasing a business's profits. We need to, like I said, give a true and fair view of the business's financial performance over the accounting period. Let's now put this into practice with a worked example. Imagine a business buys a machine for £5,000. The machine has a useful life of 5 years, and at the end of that time, it's expected to be worth £500, which is the scrap or resale value, or the residual value as we defined it on the previous slide. The asset at this point in time will have been used for 3 years. So to calculate depreciation, we take the cost of the machine minus the residual value. That gives us the total amount we want to depreciate. That's known as the depreciable amount. So 5,000 minus £500 gives a depreciable amount equal to 4,500. We spread that evenly over 5 years. So we take 4,500 and divide that by 5 years. That equals £900 of depreciation per annum. After 3 years, the business will have recorded £2,700 worth of accumulated depreciation, which will mean that the carrying amount at the end of the 3rd year is equal to the cost of £5,000 less the accumulated depreciation of £2,700 will equal £2,300. That's the carrying amount or current book value of the machine at the end of the 3rd year. That carrying amount will appear on the statement of financial position at the end of the 3rd year, showing what the current book value of the asset is, the original cost minus the accumulated depreciation, giving a true and fair view of what the asset is worth at that point in time. Current assets are the short-term resources a business owns. They're either already in the form of cash or they're expected to be converted into cash within the next 12 months. The definition of a current asset is tied to time. If the business expects to use, sell, or convert an asset into cash within a year, then it's classified as a current asset. Current assets are important because they help the business operate on a day-to-day basis. So we'll summarize the main types of current asset. First, we have inventory. These are goods that the business holds to sell to customers. Secondly, we have receivables. So these are the amounts that the customers owe the business from past credit sales. And finally, cash. That's either cash that sits in the business's bank account or cash on hand. So what unites all current assets is timing. All are expected to be used, sold, or collected within a year. So let's bring the idea of current assets to life with a very simple example. Imagine a sole trader runs a business selling cars. The cars are purchased from the manufacturer and paid for upfront in cash when they're delivered to the showroom. Now, the trader has two options when selling these cars. If the sale is a cash sale, the cars are immediately converted into cash. If the sale is a credit sale, the car is handed over to the customer, but payment is delayed until a later date. At that point in time, the customer will become a trade receivable, someone who owes money to the business, so that will be recognised on the balance sheet. So what counts as a current asset in this example? First, we have the inventory. These are the cars held for resale. Because the business plans to sell the cars in the normal course of trade, they're treated as current assets, not current assets. They may be large in size and large in value, but because the business is only holding them for a short period of time, less than 12 months, we classify them as current assets. Secondly, the trade receivables are also current assets because they're due within 1 year, they'll be converted into cash within 1 year. And then third and finally, we have cash itself, which is always classified as a current asset. Key takeaway from this slide is that current assets represent resources that will be converted into cash within 1 year. A common mistake students make is assuming that high value items like cars must always be categorized as non-current assets. The key distinction though lies in their purpose. These cars aren't used by the business for the long term, they're held for resale. That makes them inventory, and as they're expected to be sold within a year, they're going to be classified as current assets. Now let's take a look at another type of current asset which often appears on the balance sheet: prepayments. A prepayment is simply a current asset reflecting goods or services that a business has already paid for but hasn't yet received and will receive at a later date. It's an asset representing something that the business is still entitled to receive, so it has future value to the business. So for example, suppose a business with an accounting year of 31st of December pays £1,200 on the 1st of October for a 12-month insurance policy that runs from the 1st of October through to the 30th of September. By 31st of December, 3 months of that insurance policy will have been used up. That's £300 worth of expense that relates to the current reporting period. But the remaining £900 will cover the months of January to September, which falls in the next accounting year. That £900 is recorded as a prepayment. That's a current asset that sits on the balance sheet because the business has paid for insurance cover in this reporting period, but the benefits from that insurance policy haven't been received yet. It'll be received in the next accounting year. In that accounting year, the £900 will be removed from current assets and will be recorded as an expense in the income statement. Prepayments like this ensure that expenses are matched to the right accounting period, giving a true and fair view of the business's financial performance. Let's now take a look at another type of current asset you may find on the balance sheet: short-term investments. These are typically things like stocks and shares that the business holds with the intention of selling in the near future, usually within 12 months. Because the plan is to convert these investments back into cash quickly, they're going to be classified as current assets. So why might a business hold short-term investments? Well, sometimes businesses find themselves with excess cash, which is funds that aren't immediately needed for the business's day-to-day operations. So rather than leaving that cash sitting idle, the business may choose to invest it in shares or bonds, aiming to earn some additional income. The return from these investments can come from two main sources. One of those is dividends, which payments received from the companies or investments that the business invests in. Second is share price appreciation, which happens when stocks are sold for more than they're bought for. So by classifying these investments as current assets, the business's accounts will clearly show that it expects to convert them into cash within the short term. Now let's shift focus to the other side of the balance sheet and have a look at liabilities. Put simply, a liability is something the business owes. It represents an obligation to pay someone else either in cash, goods or services at some point in the future. The conceptual framework again gives us a clear definition of a liability made up of three key elements. First, there must be a present obligation. This means the business is required to do something. The obligation might come about from a legal contract, a formal agreement, or even just regular business practice. Second, the obligation must be to transfer an economic resource to another party, typically in the form of cash, but it could also be, again, in the form of goods or services. And finally, the obligation must result from a past event. That could be receiving goods on credit from a supplier, taking out a loan, or using services that haven't yet been paid for. So when we talk about liabilities, we're really talking about what the business owes others. And again, you need to be very clear on the definition of a liability and its three components before you walk into your accounting exam. Just as we can split assets into current and non-current, we can do the exact same thing for our liabilities, helping us understand which debts need to be settled sooner and which are due further down the line. First, we have our current liabilities. These are the short-term obligations the business is required to settle within the next 12 months, and includes things like trade payables, amounts owed to suppliers, or short-term bank loans and the business's annual tax payment. Then we have non-current liabilities. These are the longer term obligations that don't fall due for payment until after 12 months. A typical example of a non-current liability would be a bank loan repayable over 5 years, or long-term lease liabilities on a building or piece of equipment. The distinction between current and non-current really matters because it helps show the business's financial health, especially how well positioned it is to meet its short-term obligations as they come due. So whenever we're looking at liabilities on the balance sheet, we always need to ask the question, is this obligation due sooner or is it a more long-term financial commitment? Let's now explore some of the different types of liabilities in a bit more detail. Non-current liabilities includes loans, which are borrowings from banks or other lenders with repayment scheduled over the long term, so over 12 months into the future. We have loan stock and debentures. These are, again, longer term debt instruments, often used by larger businesses to raise finance from its investors. On the current liability side, we have loans repayable within 1 year, the short-term portion of any borrowing. Bank overdrafts, where the business's bank account has gone into a negative balance and needs to be repaid on demand. Trade payables, that's amounts owed to suppliers for goods or services that they've purchased on credit. Other payables can include money owed to HMRC for VAT, amounts owed to pension trustees, wages owed to employees for work they've already completed, things like that. We also have tax that's owed to HMRC. That includes the business's corporation tax outstanding. And finally, we have accruals. These are expenses that the business has incurred and realised the benefit from, but hasn't yet received the invoice for and is yet to pay. The key distinction to remember is that non-current liabilities reflect longer term obligations, whereas current liabilities are always going to be due within the next 12 months. One final point to be aware of when it comes to liabilities in the accounting exam is that unless we're told otherwise, we should always be assuming that cash is the resource used to settle or pay off our outstanding liabilities. This helps keep reporting consistent and understandable. So in your exam, always assume that cash is the resource used to pay off the business's debts. Cool. Let's walk through a multi-choice question. Which of the following is a non-current asset? Is it an office building, trade receivables, cash in hand, or a bank overdraft? So take a moment to think about it. The correct answer to this question is A, an office building. An office building is a non-current asset because it's used in the day-to-day operations of the business and it will be expected to provide economic benefits for more than 12 months. In terms of the other options, trade receivables are a current asset. They represent amounts owed by customers and are typically settled within 12 months. Cash in hand, it's also a current asset, it's highly liquid. And finally, bank overdrafts are a current liability. That's money the business owes to its lender, and typically it needs to be repaid pretty quickly. So remember, non-current assets are long-term and things like buildings and equipment. So we've looked at assets now, what the business owns, and we've looked at liabilities, which is what the business owes. But what about capital, sometimes called equity when we look at companies? Well, in accounting terms, capital is defined by the conceptual framework as the residual interest in the assets of the business after deducting its liabilities. So put simply, this means that once the business has paid off everything it owes to others, its liabilities, whatever assets are left belongs to the owner. And this is their capital. You can also think of capital as the owner's claim on the business, whether that's money they've originally invested or profits that have been retained in the business instead of being taken out. It's a really important metric because it tells us how much of the business's assets are financed by its owners as opposed to how much is being financed by its lenders. So capital represents the value of the business held by its owners. Capital is a critical component of the statement of financial position, sitting alongside assets and liabilities. It's one of the fundamental building blocks for understanding a business's financial health and its stability. So as we can see from this illustration, on the left-hand side of the balance sheet, we have our assets, which are used by the business to generate its revenue. On the right-hand side of the balance sheet, we can see how these assets are financed through liabilities and capital. So together, liabilities and capital represent the sources of funding used by a sole trader business to acquire and maintain its assets. Understanding this basic principle of how the balance sheet works helps provide clarity on how the business finances the purchase of its assets and how its business operations scale and grow and generate revenue, as well as profitability over time. Drawings are amounts that the owner takes out of the business for their personal use, usually cash, but sometimes in more unusual cases they'll withdraw goods from the business. So importantly, these drawings will reduce the business's capital because they're representing the owner taking value out of the business. But here's where candidates often get confused. Drawings are not the same as the owner paying themselves a wage or a salary. Wages and salaries are treated as expenses in the accounts. They're payments made to the employees in return for work being done. These expenses will appear in the profit and loss account as an expense and reduce profit. In contrast, drawings aren't treated as expenses. They're treated as reductions in capital and are not included in the income statement. So remember, when the owner withdraws money or goods, inventory from the business for personal reasons, that's a drawing. Whereas when the business owner's paying themselves a salary or a wage, that's an expense that will go through the income statement and reduce profit. Let's now look at how we calculate the closing capital for a sole trader business at the end of its accounting period. This is sometimes referred to as the end of period capital equation, and it helps us understand how the owner's stake in the business, their ownership stake, has changed over time. So the formula is as follows. End of period capital equals beginning of period capital plus profit plus any new capital introduced during the period minus drawings. So in other words, we start with the capital at the beginning of the period. That's what the owner had invested at the start of the accounting period. We then add any profit earned during the year by the business plus any additional funds that the owner has introduced into the business during the accounting period. And then finally we subtract any drawings. That's the money the owner has withdrawn for their own personal use. You may also hear the terms brought forward and carried forward capital. Brought forward capital is the opening balance at the start of the period, which is the capital brought in from the previous year. Carried forward capital is the closing balance at the end of the period, which then becomes the brought forward figure for the next year. And it is also worth noting the link between end of period capital and retained earnings. Retained earnings is simply the profit left in the business after any drawings have been taken. So retained earnings for the period equals profit minus drawings. Cool, let's now apply the end of period capital equation to a simple worked example. At the start of the year, the business had £5,000 worth of brought forward capital. That's the owner's investment in the business at the beginning of the period. During the year, the business earns a profit of £2,000. The owner also decides to invest an additional £1,000 of new capital into the business. Also during the period, the owner takes out £800 worth of drawings, which is money withdrawn from the business for their personal use. So we can now plug that all into our capital equation. End of period capital equals opening period capital plus profit incurred during the period plus capital introduced minus drawings. So that's £5,000 of opening capital plus £2,000 worth of profit, £1,000 of new capital less £800 worth of drawings. That gets us a closing or carried forward capital balance at the end of the accounting period of £7,200. And in this example, the retained earnings for the period would be the profit of £2,000 minus £800 worth of drawings equals £1,200. That would be the retained earnings if we were asked to calculate that as well. So hopefully this worked example shows how the owner's capital balance can change over time and how profit, additional capital investment and drawings all feed into the calculation. Cool, let's now test your understanding of capital with a quick sample exam question. Capital represents A, the total value of the business's assets, B, the amount invested by the owners plus any retained profits, C, the total money owned to suppliers, or D, the cash in the business's bank account. So hopefully this one's quite straightforward. The correct answer is B, the amount invested by the owners plus retained profits. Capital reflects the owner's claim on the business. It's what they've put in plus any profits that have been accrued by the business. When we prepare financial accounts for a business, there's an important principle we always follow. The idea of a business being a separate entity to its owner. In strict legal terms, if you're a sole trader, there's actually no legal difference between you and your business. The law sees you as the same person. That's the legal position. But in accounting, we do things very differently. We apply the business entity concept, which means we treat the business as if it's a completely separate person from its owner. And this matters because it helps us make sure that only business-related transactions are recorded in the business's financial accounts. Personal spending by the owner doesn't belong in business records. The objective of the business entity concept is to keep business and personal spending completely separate. This principle is key to producing clear and reliable financial information which shows the financial position of the business by itself and not mixing it with the personal finances of the owner. So while the legal view may say that the owner and the business are one, they're the same person, the accounting view says that there are two separate entities. So we've seen how accounting treats a business as separate from its owner, even when the law doesn't make that distinction. But what happens when the law does recognise the business as being a separate person to its owner? Well, that's exactly what happens when it comes to companies. A company is recognised both by law and by accountants as being a separate legal entity to its owners. This means that the company can enter into contracts, buy assets, and borrow money all in its own name, not in the names of its shareholders. And the key advantage to shareholders of company structures is that they can enjoy what's known as limited liability. So if the company runs into any trouble and is unable to pay its debts, it's run out of money, the shareholders are not personally responsible for covering those losses. Their potential loss is capped at the amount they invested in the company when they bought their shares. They don't lose a penny more than that. This legal protection encourages people to invest in companies without risking their homes and life savings. It's one of the key reasons why many businesses choose to operate as limited companies as opposed to sole traders and partnerships. So while a sole trader and their business are legally one and the same, a limited company is its own person in the eyes of the law. So now contrast a company with a sole trader, someone running a business on their own. With a sole trader, there's no legal difference between the individual and the business. The same goes for most partnerships. If the business owes money, the individual or partners owe that money too, even if they have to sell their own personal assets to pay off the debt. This lack of separation means higher personal risk, but also less formal structure and often easier setup. Sole traders and partnerships are often described as being an extension of their owners in the eyes of the law, because the law just sees them as one legal person. Whereas companies are very different. A company is a separate legal person to its owners. Shareholders own the company, but the liability is limited to the amount they've invested in it. That means their personal wealth is going to be protected if the business fails and can't pay its debts. So understanding these differences is crucial, not just for legal reasons, but also because they shape how we prepare financial accounts and how we report the financial position of a business. So, as we've seen, sole traders and partnerships offer simplicity but come with unlimited liability, whereas limited companies provide legal separation and limited liability protection for the shareholders. But there is a middle ground, a business structure that will combine the flexibility of a partnership with the legal protection of limited liability, and that's known as a limited liability partnership or an LLP. An LLP is recognised as a separate legal entity, just like a company. This means that the partnership itself can enter into contracts, own assets, and take on debts all in its own name, not in the names of the partners that own it. And crucially, the partners in an LLP enjoy limited liability like company shareholders. So if the LLP faces financial difficulties, the partners' personal assets are going to be protected. Their liability is usually limited, again, to what they've invested in the business, just like company shareholders. However, an LLP still has many features in common with traditional partnerships. There's no shareholders, instead they're called limited partners, and they take a much more active role in managing the business than company shareholders do, and profits are typically shared between the partners, and the internal structure within the organisation tends to be much more flexible than in companies. So this blend of partnership flexibility and company style legal protection makes LLPs a really popular choice for businesses, especially professional services firms like accountancy firms, legal firms, architects and consultants. Let's now take a step back and discuss how the business entity concept plays out differently in accounting and in law. In accounting, we always apply the separate entity principle. No matter what kind of business we're looking at, whether it's a sole trader, a partnership, an LLP, or a limited company, we always treat the business as if it's separate to its owners. We do this to help ensure that the financial accounts that we're reporting on focus solely on the financial position and performance of the business itself. We don't want to be blending the finances of the business with the personal finances of its owners. However, in the eyes of the law, only companies and LLPs are treated as separate legal entities to their owners. These structures exist in their own right. They can own assets, enter into legal contracts, and take on debts themselves independent of their owners. In contrast, sole traders and ordinary partnerships are not legally separate from their owners. legally the individual or the partners are the business. They're the same, seen as the same legal person. That's why the separate entity concept is so important in accounting, because it applies even when the law doesn't. Let's use an example to bring the business entity concept to life. On 1st of July 20x6, Charlie opens a flower stall business. She saved up £2,500 of her own money and transferred that amount into the business's bank account. So this is the starting point of the business. It's like the first day of the business being in existence. So from an accountant's perspective, we should immediately begin thinking in terms of what the business owns and what it owes. As from an accounting perspective, we think of the business as being its own separate entity with its own separate set of finances, which are completely independent of Charlie's own personal finances, regardless of how the business is treated under law. So with that in mind, we can say that the business now owns £2,500 worth of cash, which is an asset for the business, and the business owes £2,500 to Charlie. This is recorded in the financial statement as capital, not a liability, as it's claimed by Charlie, who's the owner, on the business's assets. If Charlie decided not to proceed with the venture, the business would repay that money to her, effectively dissolving itself in the process. So this simple example illustrates the separate entity concept, which states that under accounting rules, the business must be treated as completely separate to its owner, Charlie. So being able to apply this concept is crucial for producing meaningful financial statements. Over the course of the next few slides, we'll introduce the accounting equation. At the heart of every set of accounts is a very simple but powerful formula. Assets equals capital plus liabilities. This equation tells the story of the business's financial position. On one side of the equation, we have what the business owns, which is its assets. On the other, we see how those assets are financed, either by money the owners have put in, known as capital, or by borrowings from others, which creates liabilities. And here's the key point. The accounting equation must always balance. Every asset has a source of financing behind it. Nothing appears in the accounts without an explanation of where the money has come from. And another way to look at the equation is that equity, or capital, is what's left over after liabilities are deducted from assets. This balancing act is what makes double entry accounting work. It's the very reason why every transaction is recorded in at least two places, because every event affects at least two parts of this equation. So think of it this way through a simple example. If you own a cake shop and your oven, counter and ingredients total £50,000 worth of assets, but you borrowed only £20,000 to start the shop in the first place, then your capital, the part of the business that you own, must be worth £30,000. So every financial event, whether it's a sale, a loan, or a purchase, must keep this accounting equation in balance. So for example, if you buy a computer with cash for £5,000, then your assets will stay the same, because the computer that's coming into the business will increase non-current assets by £5,000, but cash is going to decrease by £5,000, leaving total assets completely unchanged. If you buy that same computer for £5,000 on credit, your assets again are going to increase by £5,000, but your liabilities are also going to increase by £5,000, again keeping the equation in balance. So understanding the accounting equation is absolutely essential, because it gives you a complete picture of a business's financial position at any point in time. Let's continue with the Charlie example from earlier and explore what happens from an accounting perspective when the business is first set up. So, as we discussed previously, Charlie invests £2,500 into the flower stall using her own money. This money is placed in the business's bank account, so from the business's perspective, it now owns £2,500 worth of cash. But remember, under the separate entity concept, the business owes that money back to Charlie, who's the owner. So this is recorded in the financial statements as capital, which represents Charlie's claim on the business. So in accounting terms, we express this using the accounting equation, assets equals liabilities plus capital. And for Charlie's flower stall, it's going to look like this. We have £2,500 worth of assets, which is the cash. We have no liabilities because Charlie hasn't taken on any debt. And we have £2,500 worth of capital, which is the amount owed by the business to Charlie. So there's no liabilities at this stage, no money owed to third parties, only the amount that's owed to the owner as capital. And hopefully this example illustrates how Charlie's investment into the business creates both an asset on one side of the equation and a capital entry on the other side. So the accounting equation remains in balance. So let's take a look at another example. Cliff starts a tool shop business and puts in £1,000 of his own money. That'll be recorded as capital in the accounts because it's his investment into the business, and also the business will record £1,000 worth of cash as an asset on the balance sheet. So we're told that Cliff uses some of that cash. He spends £600 on PPE. Perhaps he's buying tools, machinery, and he also spends £200 on inventory. So that's the stock he plans to sell as part of his day-to-day operations. So where does this all leave the accounts? So the business now holds £600 in PPE, £200 of inventory, and there's also been an £800 reduction in cash. So if we make the relevant adjustments, we have £200 worth of cash, £600 of PPE, and £200 of inventory, which means that total assets are unchanged at £1,000. The capital is unchanged, that stays at £1,000. And there's no liabilities at this stage because Cliff hasn't borrowed any money. So the accounting equation is still in balance and actually hasn't changed as a result of the transactions that he's undertaken. Assets equals £1,000, liabilities equals 0, and capital equals £1,000. So hopefully this simple example shows how transactions can change the composition of the balance sheet, but the accounting equation still remains in balance. Here's a question to test your understanding of the accounting equation. The accounting equation is correctly expressed as A, assets equals liabilities plus closing capital minus profit plus drawings. B, assets equals liabilities plus opening capital plus profit minus drawings. C, assets minus liabilities equals drawings plus profit. Or D, opening capital plus liabilities equals assets plus drawings minus profit. Take a moment to think it through and then we'll run through the solution. So we know that assets equals liabilities plus capital. And we also know that capital equals opening capital plus profit for the year minus drawings. Therefore, the correct answer must be B. Assets equals liabilities plus opening capital plus profit minus drawings. So it's just a little bit of algebra, just subbing in the closing capital formula into the accounting equation gets you to your answer which is option B. We've defined capital, but what causes capital to increase or decrease over time? Let's break down the following key terms as defined by the conceptual framework. First, we have revenue, which refers to increases in economic benefits, usually from the day-to-day activities of the business, like selling goods, providing services, or earning interest. Secondly, we have expenses. These are decreases in economic benefits. They cover the costs of running the business, like wages, rent, utilities, raw materials. When revenue is greater than expenses, we have profit. But when expenses are greater than revenue, i.e. costs are higher than income, we have a loss. So here's the important part of this slide. Profits don't just sit on their own. They directly increase the capital of the business. On the other hand, losses reduce capital because they represent a depletion of the business's resources. This is why even as we track revenue and expenses separately, profit and losses always tie into the accounting equation. So let's take a look at another example which will show how this all works. This time we have Eliza who runs a wedding dress business. At the start, Eliza put in £2,000 worth of capital. The business holds £1,500 worth of cash and £500 worth of inventory. That's the wedding dresses that are ready to be sold. Eliza manages to sell all of her inventory for £1,000 worth of cash. So what happens to the accounts? Well, the inventory is now reduced to 0. And we know that cash has increased by £1,000 to 2,500. The sale is going to have generated a profit of 500 because the dresses that were sitting in inventory cost £500. That's going to be our cost of sales, and we sold them for £1,000. So the profit's 500, but where does the profit go on the statement of financial position? Well, it's going to be added to retained earnings, which sits in total capital. It's increasing the capital of the business. So the business is now showing £2,500 of total assets and £2,500 of total capital. We have assets that are all cash, no liabilities, so the balance sheet has increased in size by £500. And the accounting equation should hopefully still be in balance. We have £2,000 worth of assets, £0 of liabilities, and £2,500 worth of capital, which is made up of £2,000 of opening capital and £500 of profit generated in the period. So this example shows how profit increases capital and how the accounting equation continues to balance even after sales are made and profit's been generated. Let's work through another exam style question about how certain transactions impact the accounting equation. So a sole trader sells goods for £800, which originally cost £500. Which element or elements of the accounting equation will be impacted as a result of the transaction? Is it A, assets and liabilities, B, assets and capital, C, capital and liabilities, or D, assets only? Let's pause for a moment, have a go, and we'll walk through it in a second. Okay, so the correct answer to this question is B, assets and capital, and here's why. When the goods are sold, the business receives £800 of cash, so therefore assets increase by £800. But at the same time, the inventory, another asset, is going down by £500 because goods have been sold, so inventory is leaving the business. So assets decrease by £500. The net impact on assets is an increase by 300. So we had an increase of £800 because cash has gone up by £800, but we've had a decrease of £500 because inventory's left the business. So the net impact on assets is plus £300. But this also creates a profit of £300. That's the difference between what the goods were sold for and what they cost. Again, the £800 minus the £500. That profit is added to the capital of the business because profit increases owner's equity. So capital also increases by £300. Liabilities aren't impacted here. There's no borrowing, there's no repayment involved in the scenario. So remember, when a sale is made at a profit, both assets and capital are going to be impacted. Let's look at another example now, but this time involving a drawing. So Andy runs a hairdressing business. He's invested £4,500 of his own money, and the business currently holds £3,000 in cash, £2,000 of inventory, and £500 of retained profits. Now, Andy has decided to withdraw £200 from the business to pay for some of his personal expenses, so this will be classified as a drawing. Our task is to update the balance sheet and the accounting equation for this drawing. So, the drawing causes cash to decrease by £200 from 3,000 down to 2,800, reducing total assets down from 5,000 to 4,800. But at the same time, retained earnings also falls by 200 because drawings reduce the amount of profit left in the business. So that will bring retained earnings down from £500 to £300, and therefore total capital will fall from £5,000 to 4,800. But again, the accounting equation still balances. Assets are 4,800, and that equals liabilities of 0 plus capital of 4,800. So again, the key takeaway here is that drawings reduce cash and owner's capital on the balance sheet. They're never treated as expenses, and again, the accounting equation remains in balance once we've processed the drawing. In this section of the material, we're going to explore credit transactions, a key part of everyday business operations. So when a business buys or sells on credit, payment doesn't take place straight away. Instead, one party delivers the goods or services right now, and the other agrees to pay them the cash they owe at a later date. This creates two important groups you'll often see in a business's accounts. First, we have the debtors, also known as trade receivables. These are the customers who owe money to the business because they've either bought goods or services on credit. Debtors are considered assets because they represent cash that the business expects to receive in the future. Secondly, we have creditors or trade payables. These are the suppliers to whom the business owes money to, for goods or services it's received but not yet paid the cash for. Creditors are recorded as liabilities, and their future amounts the business is committed to paying. Understanding how credit works and how debtors and creditors fit into the accounting equation is really important for tracking the financial health of a business. Let's now take a closer look at trade receivables. Trade receivables represent amounts owed to the business by its customers, usually because the business has sold goods or services to them on credit. In accounting, we classify trade receivables as a current asset because they're typically expected to be paid off within 30, 60 or 90 days, depending on the credit terms agreed with the customer. Let's now walk through how trade receivables are accounted for in two simple steps. So step one, a sale is made to the customer on credit. This means that the business is transferring the goods or services to the buyer now, but the customer agrees to pay later. At this point, two things happen in the accounting system. One, revenue is recognised, even though no cash has been received yet, so revenue is recognised in the income statement. And secondly, on the balance sheet, a trade receivable is recorded representing the amount the customer owes. Step two, the customer pays the amount they owe, so the business now receives the cash, so the cash balance increases, and also receivables decreases because the outstanding balance has been cleared. Importantly, there's no new revenue recognised at this stage because the income was already recognised in step one when the sale was made. So we don't need to recognise any more revenue when the cash is eventually received. So in summary, trade receivables are crucial for tracking how much money is owed by customers, and they play a key role in managing cash flow and understanding the financial health of a business. So let's look at the typical timeline of a trade receivables transaction. So on the 1st of March, a business called Maple Interiors sells £4,500 worth of furniture on credit to a customer called Nova. Under the agreed terms, Nova has 60 days to pay. So for the next 2 months, Nova is considered a debtor to Maple Interiors as they owe money to Maple. So £4,500 of revenue is recognised on this date when the transaction takes place. Maple records this £4,500 as a trade receivable on the balance sheet, and it's a current asset because the business expects to receive the cash in less than 12 months. Importantly, the revenue is recognised straight away on the date 1st of March, not when the cash is received. So revenue is recognised when the sale is made on the 1st of March, not when the cash is eventually received by the business. Then when Nova makes the payment 2 months later, on the 30th of April, the trade receivable is removed from the books and the £4,500 amount is replaced by cash on the balance sheet. Again, there's no additional revenue recognised at this point. The sale was accounted for back on the 1st of March. That's when the revenue was recorded. So yeah, hopefully this illustrative timeline helps clarify how trade receivables work, tracking the amounts owed by customers and making sure they're cleared once the payment is eventually received. Let's now apply everything we've learned about receivables with an example focusing on Chris and his clothing store business. To begin with, Chris had £1,500 worth of capital, £400 worth of cash, £1,100 of inventory. Chris decides to purchase an extra £200 worth of clothes, paying in cash. Then Chris sells some of that stock for £400 on credit, meaning the customer will pay her a little bit later. So the purchases reduce cash by £200. and increase inventory by £200. But after that, the sale is going to reduce inventory by £200 and increase trade receivables by £400, and it will generate profit of £200 because profit is calculated as the difference between the sales price of £400 and the cost of sales, which was £200. That capital is added to capital as retained earnings, which will increase owner's capital from 1,500 to 1,700. The final balance sheet shows £200 worth of cash, 1,100 of inventory, 400 of receivables, and 1,700 of total assets. And then we have capital of 1,700 on the other side. So the accounting equation again remains perfectly balanced. We have £1,700 worth of assets funded by £0 worth of liabilities plus £1,700 worth of capital. So this example shows how trade receivables arise from credit sales and how profit feeds back into the capital of the business. So far when we've thought about receivables, we've spoken specifically about trade receivables, amounts that are owed by customers who've bought goods or services on credit. But it's important to understand that not all receivables arise from credit sales. A receivable is simply just money owed to the business by another party. So while credit customers are the most common source of receivables, receivables can also arise from a wide variety of other situations. So for example, the business might be waiting for an insurance claim to be paid out or a VAT refund from the tax authorities to be received. Another classic example is when loans are made to employees. So for example, rail season tickets. These are all classified as other receivables because they don't come from selling goods or services to customers on credit, but they're still scenarios where a business is owed money by someone else. The key distinction to remember is trade receivables arise from credit sales to customers, whereas other receivables cover everything else that the business is owed. Both types of receivables appear as current assets on the statement of financial position, but understanding that there is a distinction helps paint a clearer picture of where the business's outstanding amounts are coming from. Let's now take a closer look at trade payables. Trade payables represent amounts owed by the business to its suppliers. These arise when the business buys goods or services on credit, agreeing to pay the supplier at a later date. In the accounts, trade payables are always classified as current liabilities because payment is typically due within 30, 60 or 90 days from the purchase having taken place, depending on the credit terms. It's a perfectly normal part of running a business to purchase supplies and raw materials on credit, and doing so helps manage the business's cash flow. Let's now talk through how trade payables are treated in the accounting system. Step one is when the business receives goods or services from a supplier but agrees to pay them at a later date. At this point, the business recognises the purchase in the income statement, but also recognises a liability called a trade payable to show that money is now owed by the business to a supplier. Both costs and payables increase at this stage, but no cash has left the business just yet. Step two is where the business eventually pays the supplier. Now the cash value on the balance sheet goes down and the trade payable is removed from the balance sheet because the obligation has been settled. There's no new impact on the income statement at this point, as the purchase cost was recognised back when the goods were received in step one. So we don't need to double count and recognise them again as part of the second step. Just like with trade receivables, the key point is that the purchase itself is recorded at the time the goods or services were received, not when the cash is paid out. So to summarise, trade payables show how much the business owes to its suppliers, and they're essential for understanding a business's short-term obligations and cash needs. Let's now take a look at a trade payables timeline. On the 1st of September, a business called Willow Supplies purchases £3,500 worth of materials on credit from its supplier, Oak Trading. The invoice includes 30-day credit terms, meaning Willow has up to the 30th of September to pay the amount that's owed. During this time, Oak is a creditor to Willow, and the £3,500 is recognised as a trade payable, which is a current liability in Willow's accounts. The payable represents the business's obligation, which they need to pay off in the near future. When Willow finally makes the payment on the 30th of September, the trade payable is reduced down to zero, and Willow's cash balance will decrease by £3,500. So this timeline shows exactly how trade payables work, tracking what the business owes and how the debt is settled over time. Let's also look at how trade payables work in practice with an example from Donna's birthday cake business. Donna's business has £3,000 worth of capital, £1,200 worth of cash, and £1,500 worth of inventory, which is the cakes she plans to sell. Donna decides to purchase a £500 delivery van to help with customer deliveries, but instead of paying up front, she's decided to buy the van on credit with 30-day payment terms. So the question we need to answer is, how does this transaction impact the balance sheet? Well, the transaction is going to increase the business's assets because we're introducing a £500 van into the business, but at the same time, it's going to create a trade payable of £500, which is recorded as a liability, the amount the business owes to the van's supplier. There's no immediate impact on cash. And there's no immediate impact on capital either, because the business hasn't paid for the delivery van yet. So we have total assets of £3,500, capital of £3,000, and liabilities of £500. Total up the revised balance sheet, and the accounting equation remains in balance. We have assets of £3,500, which are funded by capital of £3,000 and liabilities of £500. So credit purchase give rise to trade payables, and this will increase both total assets and total liabilities. Let's look at another worked example. This time it's Diana and her gardening business. At the start of the period, Diana has £4,000 of capital, £1,000 of cash, and £3,000 of inventory on the asset side. Diana then decides to make two important financing decisions. One, she invests an extra £500 of her own money into the business, which increases both capital and cash. Second, she decides to take out a bank loan of £750, which will increase the business's liabilities, but again, that's also going to increase cash by the same amount. So let's have a look at how this is going to impact the balance sheet. We start with the equity investment, so that's going to be £500 of extra cash and £500 of extra capital, and the loan is also going to increase cash by £750, so the total impact on assets is going to be plus 1,250, and the loan is also going to increase our liabilities. So after we've factored in these two transactions, the balance sheet is now going to show £2,250 worth of cash. That's the original £1,000 plus the £500 capital injection plus the £750 loan. And then we have £3,000 of inventory, so £5,250 of total assets. Capital has risen to £4,500, and liabilities now stand at £750 as we have a new loan that needs to be paid off. So, and again, the accounting equation, let's see if it balances. We've got 5,250 on the asset side, 750 in liabilities, 4,500 in capital. So yeah, the accounting equation again is perfectly in balance. So this example shows how capital injections and taking out a loan impact the balance sheet. They increase capital, they increase liabilities, but still the accounting equation remains in balance. Let's test your understanding of how transactions affect the accounting equation through this next question. So a business purchases £2,000 of equipment on credit from a supplier. Which element or elements of the accounting equation are going to change as a result of this transaction? Is it A, assets and capital, B, assets and liabilities, C, capital and liabilities, or D, just assets? The correct answer here is assets and liabilities. When the business purchases equipment on credit, the equipment is going to increase assets because the business now owns this new piece of equipment, which is going to increase PPE and it's going to increase total assets. But at the same time, the business hasn't paid for those assets yet, so it owes its supplier. This is going to create a trade payable, which is going to increase liabilities, specifically current liabilities. Capital is unchanged as a result of this transaction. The business hasn't earned any profit, there's no new owner investment in the business, there's no drawing that's taken place. It's simply an exchange between assets and liabilities. So the correct answer is B. When a purchase is made on credit, only assets and liabilities are impacted. Let's now explore one of the most important financial reports, the statement of financial position, often commonly known as the balance sheet. The balance sheet provides a snapshot of a business's financial health at a single point in time. Think of it like a snapshot of the company's finances taken on a particular day, showing exactly what the business owns, what it owes, and how much belongs to the owners. The report is built around the accounting equation that we've discussed, assets equals capital plus liabilities. But instead of simply stating the formula, the balance sheet presents the numbers in a structured and a far more detailed way, making it easier for owners, managers, other stakeholders to understand the business's financial health in greater detail. In this section, we're going to break down each part of the statement of financial position so you can see exactly how it works and how it connects back to the accounting equation. So, although the statement of financial position is rooted in the accounting equation, there are two main differences. First, how the figures are presented in terms of its format. Second, the balance sheet includes a hell of a lot more detail than the accounting equation. It includes things like itemized breakdowns of assets, liabilities, capital, etc. The accounting equation is simple. It shows assets and it shows capital and liabilities. So in our example on the slide, we have total assets of 10,000 and these assets are financed using £7,000 worth of capital and a £3,000 loan. It's pretty simple, the accounting equation. That's what it tells you. It's quite high level. Whereas on the other hand, the statement of financial position presents the same information, but in much greater detail. It lists out the assets on one side, and it shows capital and liabilities, i.e. the source of funding, on the other side. So in this example, we've got assets including cash, inventory and equipment. We've got capital, which represents the owner's investment in the business, and we've got liabilities, which can include things like loans, payables, or other obligations. Just like the accounting equation, both sides of the balance sheet need to be equal, and this is why we call it the statement of financial position. It shows where the business stands at a particular point in time. Here we look at the two ways that the statement of financial position can be visually presented. It includes the exact same numbers from the previous slide. The first is the IAS 1 format, where we list asset on one side and capital and liabilities on the other. So in our example, the business owns £10,000 worth of assets, made up of £2,000 of cash, £3,000 of inventory, £5,000 of PPE, and these assets are financed using £7,000 worth of capital, £3,000 of liabilities. The second format is used under UK GAAP. It splits the information into two halves. First, we calculate net assets by subtracting liabilities from assets. Then we show that these net assets are financed using £7,000 worth of owner's capital. And this 7,000 can also be described as owner's capital. Both layouts show the same thing. They show the exact same financial position, just in slightly different formats. In this accounting course, we'll just be using the IAS 1 format, where capital and liabilities are grouped together. So don't worry too much about the presentation under UK GAAP. And finally, net assets. We briefly touched upon net assets on the previous slide. Net assets are defined as the total assets of the business minus total liabilities. The calculation is central to understanding how much of the business's resources are funded by its owners, and this is also known as capital. Again, just revisiting the calculation from the previous slide again, we have £10,000 worth of assets minus £3,000 worth of liabilities gives us net assets of £7,000. Let's now explore the statement of profit or loss, the financial statement that shows how much income the business has earned and the expenses it's incurred to generate that income, ultimately arriving at the profit or loss for the period. You often hear this financial statement referred to as the income statement. It's important to understand how the income statement differs to the balance sheet. While the balance sheet gives us a snapshot of the business's financial position at a single moment in time, the statement of profit or loss illustrates the financial performance of the business over a period of time. The statement of profit or loss follows the accruals concept. This means that income is recorded when it's earned and expenses are recorded when they're incurred, not necessarily when the cash is received or paid. This approach ensures that income is matched against the expenses that relate to earning that income. The key question the statement of profit or loss helps to answer is, how well did the business perform financially during the period? Was it profitable or was it loss-making? In the next few slides, we'll break down exactly how the income statement is structured and how each part fits together to tell the overall financial story of the business's performance. Cool, let's take a closer look at two key figures in the statement of profit or loss. We've got gross profit and we've got net profit. Firstly, gross profit is calculated by subtracting the cost of sales from revenue. It shows how much profit the business makes from its core business or trading activities before we deduct any overheads and operating costs. Gross profit is a useful measure of a business's trading efficiency because it tells us how well the business is managing things like pricing, purchasing, and inventory management. Then we move on to net profit. This is calculated by taking the gross profit and subtracting all of the business's other costs, all of its expenses such as rent, salaries, insurance costs, depreciation, and interest. But also, to get to net profit, we also need to add in any non-trading income the business has earned. Non-trading income might include bank interest, rental income, or returns from financial investments. These are the sources of income that sit outside of the main trading activities that the business undertakes. They are completely unrelated to the company's goods or services. So the formula for net profit is gross profit minus expenses plus non-trading income. In simple terms, gross profit focuses on the profit made from the business's core activities, whereas net profit gives us the overall bottom line result after all costs and additional income have been accounted for. So to bring these concepts to life, let's walk through a simple example of a statement of profit or loss. In this case, the business has generated £100,000 worth of revenue. From this, we subtract the cost of sales, which are 60,000. These are the direct costs of producing or purchasing the goods or services the business sells. That leaves us with a gross profit of 40,000 for the period. Next, we need to deduct the expenses. These are things like rent, wages, insurance, and all other operating costs. These costs altogether come to £24,000. But before we calculate net profit, we also need to factor in any other non-trading income the business has earned during the accounting period. This includes things like interest received, rental income, investment income, essentially any income that doesn't come from the core trading activities. And this comes to £5,000. So we take gross profit, we deduct the expenses, and we add on non-trading income. That leaves us with a net profit for the period of £21,000. That's the bottom line result for the business. Let's now take a closer look at gross profit and how it connects to gross profit margin. As we discussed on the previous slide, gross profit represents the difference between sales revenue and the cost of sales. Put simply, it tells us how much profit the business is making from the sales of its goods before deducting other indirect expenses like rent, wages, or administrative costs. But what goes into the cost of sales really depends on the type of business we're looking at. In retail businesses, cost of sales is typically just the cost of buying the goods it's reselling, like what a shop pays its supplier for its inventory, which it then goes on to resell at a profit. But in manufacturing businesses, where the business actually makes the goods it's selling itself, cost of sales is far more detailed. It's going to include things like raw materials, direct labour, and a share of production overheads, things like factory rent or equipment depreciation. To assess profitability on a relative basis, we need to look at the gross profit margin. This expresses gross profit as a percentage of revenue using the formula gross profit margin equals gross profit divided by revenue multiplied by 100. A higher gross profit margin means the business is keeping more money from each sale, which can then be used to cover the other costs of the business, the operating costs, or to boost its profits. Gross margin is a useful tool for tracking a business's performance over time and for comparing the performance of different businesses within the same industry. In short, gross profit shows profitability in pounds, and gross profit margin shows profitability on a relative basis, i.e. in percentage terms. But both are key to understanding how well a business is managing its trading activity. Let's now take a deeper dive into net profit. Net profit tells us the business's overall financial performance after taking into account all sources of income and all business expenses, not just those linked to the selling of goods. So the formula for net profit is gross profit plus income from other sources minus any business expenses not already accounted for in cost of sales. So what might these additional income sources include? We've got profit from selling non-current assets, so capital income, dividends and interest income from investments, rental income from subletting space or leasing out property, and insurance claims. received by the business. These are all forms of non-trading income earned outside of the business's core operations. Next, we need to subtract any remaining business expenses that weren't captured in cost of sales. These are typically split into three main categories. First, we have distribution costs. These include salaries for marketing and sales staff, marketing expenses, and the cost of running and maintaining the business's delivery vehicles. Second, we have administrative expenses. These are the day-to-day costs of running the business and include things like office and management salaries, rent, heating and utilities costs, lighting, insurance, and also property taxes and things like software, stationery, and general maintenance costs. Third, we have what's called finance costs, which include interest on bank loans and interest on any overdrafts the business has with its bank or lender. Once all of these costs are accounted for, we're left with net profit, which is the true bottom line figure for a business, showing what it earned over the accounting period. The net profit figure is crucial for understanding how profitable a business really is and how well it's using both its income and its resources. To ensure the statement of profit or loss gives an accurate picture, we need to align both income and expenses to the period in which they actually occur, not when the cash changes hands, and that's where accruals and prepayments come in. A prepayment is a cost paid in advance for goods or services that will be received in a future period. For example, if a business pays next year's rent this year, the payment will be recorded as a current asset, not an expense, in the statement of financial position. Although cash has been paid out, the benefit hasn't yet been received by the business. The prepayment will be moved from the balance sheet to the income statement in the next year when the expense is actually incurred. On the other hand, accruals or accrued expenses are the cost that a business has already incurred in the current accounting period, and has received the benefits from, but for which it has not yet paid for and will pay in the next accounting period. An accrual is the opposite of a prepayment. It's when the business has received some form of benefit but is yet to pay for it. And accruals are recognised in the income statement when they're incurred in the current accounting period, and they're also included in the balance sheet as payables. Prepayments and accruals help match costs and income to the correct accounting period, ensuring accuracy as well as transparency in a business's financial reporting. Let's take a brief moment to think about how we connect the two key financial statements, the income statement and the balance sheet. The net profit number shown at the bottom of the income statement doesn't just sit there in isolation. It actually flows directly into the balance sheet by increasing the owner's capital account. This reflects the idea that profits belong to the owner and form part of their investment in the business. On the other hand, if the business makes a loss, the opposite happens. The loss reduces the capital balance, given that the business's resources have effectively been depleted. And it's important to also understand how drawings fit into all of this. Drawings are the amounts taken out of the business by the owner for personal use. They reduce the capital account on the balance sheet just like a loss would, but they're not included on the income statement because they're not considered a business expense. And the opposite applies to capital contributions made by the owner. Capital contributions increase balance sheet capital. So to summarise, profit increases capital, whereas losses reduce capital. Drawings reduce capital and contributions increase capital.